Welcome to the deep dive. Today, we're really digging into some pretty critical market warning signs. We're looking across Bitcoin, major indices, U.S. equities, the whole lot.
Oh, yeah.
And our mission really is to pull out the key nuggets from the research we've analyzed just to give you a clear, sharp sense of what's actually driving these markets right now, because it can get confusing.
Oh, absolutely. And this is particularly relevant now, I think, because, you look at the fundamentals, maybe you hear talk about interest rate cuts coming out of Jackson Hole soon.
Right. Sounds bullish on the surface.
Exactly. It seems bullish. But when you look at the technicals, the underlying structure, it's telling a very different story. We're seeing market exhaustion, momentum just fading away. Understanding these, let's say, more nuanced signals, that's really key for your perspective right now.
Okay, so let's lay it out. What are we focusing on for you today? The three core areas.
That's the plan.
First, these striking parallels Bitcoin showing to past market tops. That sounds ominous.
It's worth looking at, definitely.
Second, something often overlooked maybe, the importance of cash indices for the equity market.
Hugely important. We'll get into why.
And finally, this extreme concentration risk. Sounds like it's all about AI and the NASDAQ.
Pretty much, yeah.
Yeah.
Especially one stock in particular.
All right, let's get into it. Let's start with that bigger picture. There's definitely buzz around Fed Chair Powell, Jackson Hole, potential rate cuts starting maybe September.
Yep, that's the chatter.
But, you said the technicals tell a different story. What's the actual pulse, according to the research? Exhaustion.
Yeah, exhaustion is the word. Despite that potentially bullish news backdrop, the analysis points to this palpable exhaustion seeping in.
Okay.
And it looks like more than just a simple pullback. The research is calling it a potential midterm market top.
Midterm top, so not just a dip.
Exactly. And it's characterized by what's termed active distribution.
Active distribution. What does that mean in practice?
Well, think of it like deliberate price action. It's designed to shake people out. Specifically, stop out late longs people who bought near the top.
Trapping them.
Right. And at the same time, making it hard for people to short the market easily by triggering these multiple stop runs, quick moves up just to liquidate shorts.
Wow. Okay, so it's manipulation, essentially.
It's strategic price action, let's say. It signals a potential major turning point, often before the big move down happens.
That sounds quite calculated. Okay, let's pivot to Bitcoin then. The sources mention striking historical parallels. What are we seeing?
Yeah, this is fascinating. The analysis draws a really strong parallel to the March 2021 market top for Bitcoin.
Okay, 2021, what are the signs?
We're seeing significant bearish divergences. Basically, Bitcoin's price makes higher highs.
Which looks good on the surface.
Right. But key momentum indicators like the RSI are making lower highs. On weekly charts, on daily charts, it's like, the engine is losing power even as the car speeds up for a bit.
A classic warning sign.
A classic sign of underlying weakness, yeah. And crucially, there's something confirming right now. A critical inside 2-week candle failure inversion.
Whoa, okay, break that down for us. Inside candle. Failure inversion.
Right. So an inside candle just means a period of indecision, consolidation. Price stays within the range of the previous candle.
Okay.
The failure inversion part is key. It means price tried to break higher out of that indecision, but failed immediately, reversed, and closed below the prior candle's low.
Trapping the bulls who bought the breakout.
Exactly. It's a strong rejection of higher prices, often leads to a pretty significant drop. And add to that, Bitcoin's been struggling, really wrestling for about a month now with its R1 yearly pivot.
R1 yearly pivot. That's a technical level.
Yeah, it's at $121,767. These yearly pivots are calculated from the previous year's price data. Wall Street algos, they pay very close attention to these levels.
And Bitcoin's more institutional now, right?
Absolutely. It's considered a mature asset now, influenced by these algorithms. And historically, these R1 pivots, especially for mature assets, can mark major trend reversals.
Okay. And talking about Wall Street influence, MicroStrategy, MSTR. It's become sort of the proxy for Bitcoin on the stocks market.
The poster child, as the research calls it. Yeah.
So what's its role here? Is it acting as a leading indicator?
It really seems to be. Almost like the canary in the coal mine for Bitcoin right now. MSTR is showing like the exact same topping pattern we saw back in 2021.
The same pattern.
The exact same, which strongly suggests that ripple effects or reverberation effects, as the analysis puts it, for Bitcoin are imminent.
Okay. How so? Is there a specific signal?
Yeah, there's this MSTR BTC monthly divergence. It's pretty stark. In July, just passed, MSTR's price poked higher briefly, a fake out, basically.
Luring buyers in.
Precisely. But then it closed the month down, forming what's called a swing failure pattern, or SFT. That's when price breaks a key level but can't hold it and snaps back.
Okay, and Bitcoin.
Bitcoin actually closed higher that same month. So MSTR fails, Bitcoin makes a higher close. That divergence, it suggests MSTR has been given the memo.
The memo to go down.
Essentially, yeah. The signal is that MSTR needs to start following Bitcoin's likely downward path. It's a big warning sign for a potential market structure shift.
Wow, that's a subtle but powerful signal. So for you listening, what are the practical takeaways here? How should you position yourself strategically?
Well, the advice from the analysis we looked at is pretty blunt, actually. It says, don't be long on the market, period.
Don't be long, period.
Yeah. Avoid new long positions on risk assets like Bitcoin. And if you have profits, now is probably the time to think about taking them.
Okay. Any key levels for Bitcoin?
Yes, absolutely. The critical support to watch is $111,980. If Bitcoin closes a month below that level, that could trigger a significant inside monthly candle failure, basically confirming much deeper downside.
So wait for that confirmation before getting aggressive short.
Exactly. Aggressive shorts are really only advised after a confirmed monthly close below that $111,980 level.
Got it.
And, this ties back to those yearly pivots we mentioned. There's something called the R5 blind short rule. R5 is another resistance level way up.
Blind short, meaning?
Meaning it's often such a strong resistance, such a likely topping point, that some traders might short it almost automatically without needing tons of other confirmation.
And are there examples of this working?
Yeah, the analysis cited a couple. Joby Aviation, JOBY, apparently topped out precisely at its R5 yearly pivot, and Archer Aviation, ACHR, saw a sharp rejection right from its R1 yearly pivot.
So these levels are actively traded by algorithms.
It really demonstrates how algorithms respect and trade around these predefined levels. It's quite mechanical.
That focus on cash indices over futures is really interesting. It's something I think a lot of retail traders might miss.
It's easy to miss because futures charts are so readily available, right? But the institutional money, the big flow that actually moves the market, it operates based on the cash index, DJI, SPX, NDX.
And the analysis found issues there. Inefficiencies.
Yeah, major downside inefficiencies. Things like flat opens. That's a candle with basically no wick at the open, suggesting immediate selling pressure right from the start. And significant open gaps on weekly and even 3-week charts for the Dow Jones, DJI, and S&P 500 SPX.
Gaps meaning areas where price jumped, leaving no trades.
Exactly. And historically, these kinds of gaps and inefficiencies, they tend to act like magnets. Price often needs to come back down to sort them out, fill the gap, trade in that area.
So they represent downside targets.
They represent a draw on price, yeah. A reason for the market to potentially correct.
Were there specific examples you found compelling in the research?
There was a really good learning moment described comparing US 30, which is Dow Jones futures, versus the actual DJI cash index.
Okay.
The analyst saw a strong short setup on the futures chart. Looked perfect, but hesitated. Why? Because the DJI cash index hadn't actually hit its all-time high yet, even though the futures had poked above.
Ah, so the cash index was lagging.
Exactly. And the hesitation, that gut feeling, was based on knowing the institutional algorithms prioritize the cash index. They waited for DJI to make its high before the real downturn started. It shows how sometimes that gut feel is just your brain processing reliable past information, like the structure of the DJI chart.
That's a great insight. Any specific gaps we should know about now?
Yeah, for the DJI, there's an open gap highlighted on the 3-week chart between 43,588 and 43,724. And below that, on the weekly chart, there's a flat open candle. That whole area is acting as a current downside draw.
Okay. And the S&P 500, the SPX?
The SPX analysis described the recent move up as insanely inefficient, just straight up leaving open gaps on the weekly, the 2-week, and the 3-week chart.
Wow, multiple time frames.
Yeah. And the analysis drew parallels to historical examples like the yen carry trade collapse or the 2022 rate hike cycle start. In both cases, similar inefficient moves up left gaps that were eventually filled, sometimes quite dramatically.
And the timeline for filling these current gaps?
The expectation mentioned is potentially August-September for price to revisit those areas.
Okay, that ties back into the whole midterm top idea. Let's shift gears again. The AI revolution and its impact on the NASDAQ. The analysis mentioned extreme concentration risk. What's going on there?
Yeah, this is pretty striking. You'd think Microsoft MSFT would be leading the charge, right? But post-earnings, it's actually been lagging.
Lagging? How so?
Well, it had a huge 7% gap down at the monthly open back on April 30th, and then printed two bearish weekly candles after that. It hasn't really recovered strongly.
Interesting. So if not Microsoft, then who's driving the NASDAQ?
This is the concerning part. The analysis states the NASDAQ is now 100% copying NVIDIA's price action on a day-over-day basis.
100%. Just NVIDIA.
That's what the research indicates. It points to this dangerous dependency. The entire index's fate, at least in the short term, seems tethered completely to NVIDIA's NVDA's earnings report.
Which is when?
August 27th. That date is flagged as the primary catalyst capable of triggering a market-wide pullback.
Wow. All eyes on NVDA earnings then.
Absolutely. And adding to the caution, there's been this recent trend, right? Lots of stocks have actually gone down after reporting earnings this season, even if they beat expectations.
Sell the news phenomenon.
Could be. It adds another layer of risk around that NVIDIA report.
So NVIDIA is the absolute linchpin. What about other AI-related stocks? Any interesting observations there, maybe strengths or vulnerabilities?
Well, Broadcom, AVGO, was highlighted for showing just, well, unprecedented historical price action.
Unprecedented how?
It apparently printed 10 consecutive two-week bullish candles in a row.
10. That's a lot.
It's highly unusual, yeah. Suggests it's incredibly overbought and unsustainable. The analysis strongly suggests that at least one or two bearish two-week candles, basically a pullback, are imminent.
So expect AVGO to cool off.
Yeah, likely triggered by whatever happens with NVIDIA. But interestingly, that pullback is seen as potentially an ideal entry for swing-long positions for people looking to buy a dip in a strong name.
Okay, so potential opportunity there after the pullback. Anyone else?
Google, GOGL, gets a positive mention. Called one of the best AI companies.
Why Google?
Because of the powerful integration and superior capabilities of its Gemini AI models across its whole ecosystem, search, Android workspace, everything.
So it's about the integration.
Exactly. The focus seems to be on integrating AI for regular users seamlessly, which is maybe different from Microsoft's more business-focused integration.
Interesting distinction. What about Apple? AI is big news for them too.
Apple, AAPL, yes. Its chart actually still looks bullish, according to the analysis, expected to make a new all-time high.
Driven by AI innovation.
Surprisingly, no. The analysis attributes Apple's strength more to the massive stock buybacks they announced back in May. That artificially supports the share price.
Right. Less about fundamentals, more about financial engineering. Got it. Okay, so given all this caution, especially around Bitcoin and the indices, what's the guidance on altcoins? Ethereum, Solana, big names there.
Yeah, the general warning holds. If Bitcoin takes a significant hit, you have to expect altcoins will suffer too, probably even more. So general caution is definitely needed.
But any specific strategies?
For Ethereum, ETH, the advice was actually shorting ETH is not advised.
Oh, no.
Because it remains one of the strongest altcoins, fundamentally and technically. It's showing relative strength.
Okay, so no shorting ETH. What about buying?
The ideal scenario, outlined for a swing-long position, maybe a shorter-term trade, is waiting for a pullback. Specifically to the 25% range level, which is around $3,870.
25% range level.
Yeah.
Like a Fibonacci level.
Could be Fibonacci, or just a key support derived from the recent price range. Alternatively, there's a daily support zone identified between $3,550 and $3,720. Buying in that area is seen as offering amazing risk-reward.
And its strength shows up against Bitcoin, too.
Yeah, the ETH-BTC chart, which compares the two, is apparently looking strong for Ethereum.
Okay. What about Solana, SOL? It gets a lot of attention, too.
Solana is viewed more through a longer-term strategy lens in the analysis.
Longer term how?
The anticipation is that Solana will see institutional investments start to flow in, similar to how it happened with Ethereum.
And that would drive the price.
Potentially causing it to double, targeting at least $400. It's framed as potentially a cheaper deal than Ethereum right now, with just getting back to its old all-time high, offering something like a 54% return.
So a long-term hold potentially. What's the entry strategy?
Patience. The advice is to wait for Bitcoin's correction to fully resolve, maybe assess the situation around October, and then consider starting a spot-long position, meaning no leverage.
And the levels to watch for entry.
If Solana corrects down to around $155 or $161, those are highlighted as potential entry zones for that longer-term spot hold.
Okay, patience and specific levels for Solana. Got it. So let's try and wrap this all up. It's been a really insightful deep dive. Key takeaways. Strong signals of a midterm top across the board, right?
Yeah, risk assets look vulnerable. Bitcoin's at a critical point, MSTR acting as that leading indicator.
And the cash indices, their supremacy, and those inefficiencies acting like downside magnets. Can't ignore those.
Absolutely. Plus, the huge concentration risk in the NASDAQ queue, basically hanging on NVIDIA's earnings.
Right. So the strategic advice boils down to...
Pretty clearly, avoid new longs, protect your capital, take profits where you have them, and then utilize your dry powder, your cash.
Ready to buy the dip.
Exactly. Be ready to enter long positions, but selectively. High-quality assets like Ethereum, aiming for that $3,550 to $300 to $720 zone, and Solana targeting $155 to $161 for those longer-term spot holds.
With an eye towards...
With an eye towards potentially a very bullish 2026 for assets like these, assuming this correction plays out first.
Okay. Well, this deep dive was really designed to arm you with these insights, help you form your own informed perspective.
Yeah.
And maybe one final thought to leave you with. Considering how much algorithms and single stocks, like NVIDIA, seem to be driving entire indices now, what does that really mean? What are the implications of this extreme concentration, this algorithmic trading, for the overall stability of our financial markets?
That's a big question. Definitely something worth pondering.
Something to think about as you navigate what comes next. Thanks for joining us on the Deep Dive.